like the trading world is kinda, I don't know, rigged? Well, today we're gonna dive deep into the one concept that explains pretty much everything: liquidity. This is the secret to understanding who's really winning and why. Oh, I am willing to bet this looks painfully familiar. You do all your homework, you find the perfect entry, you set a responsible stop loss, and then bam, the price just dips down, kisses your stop by a single tick, and then skyrockets right to your target without you. It is absolutely maddening, isn't it? And I'm here to tell you it is not an accident. So what if that moment, that peak frustration, wasn't just bad luck? What if it was actually an event that was engineered on purpose? Today, we're going to pull back that curtain and show you exactly how this game is played. All right, let's start by digging into this whole stop-loss mystery. I mean, why does it always feel like the market has a personal vendetta against your trades? Think about how most of us were taught to trade. It's almost like we were put on this assembly line and handed the same box of tools: chart patterns, trend lines, a few common indicators. The problem is, we're all being taught to see the market in the exact same predictable way. And here's the huge problem with that. Almost all of those tools are lagging. They show you what has already happened. So by the time a pattern is crystal clear on your chart, you're basically being told to chase a train that's already pulling out of the station. And even worse, the big players, they're waiting on the platform, ready to take the other side of your trade. You're walking right into a trap. Which brings us to what I like to call the great deception. This is where we break the illusion, where we see that all those patterns you've been taught to trust, well, they're not what they seem at all. You have to get this into your head. The market is a zero-sum game. It's a cat and mouse game, plain and simple. For the big institutions, they're the cats. To fill their massive orders, they need liquidity. They absolutely have to have someone to trade against. And who is that someone? Well, it's often the predictable retail trader. Yep, the mouse. Okay, let's take a classic example. You see a double bottom forming. Your trading textbook screams at you that this is a strong reversal pattern. Price hit a support level twice and it held up. So what do? You buy. And you place your stop loss just below that nice, clean support line, right? Of course you do. But here's the twist. An institution sees that exact same pattern completely differently. They don't see support. They see a giant flashing neon sign that says pool of liquidity here. They know with absolute certainty that just below that obvious level is a massive cluster of stop-loss orders from every single retail trader who just bought that double bottom. And that cluster of sell orders, that is what we call liquidity. It's literally the fuel that makes the market engine run. If a big bank wants to buy $1 billion worth of something, they can't just click buy like we do. It would spike the price. They need to find a ton of sellers. And where's the most concentrated pool of willing sellers? It's always right where we predictable retail traders place our stop losses. This whole situation leads to what's called a liquidity grab or a stop hunt. The institutions will deliberately push the price below that support level, just far enough to trigger all those stop losses. This sudden flood of automatic sell orders gives them all the liquidity they need to fill their huge buy positions at a fantastic price. And then what happens? The price reverses and flies up just like you predicted it would. And hey, it's not just double bottoms. Every single classic pattern you've ever learned, support and resistance, trend lines, flag patterns, you name it, they are all just magnets for liquidity. They are simply areas where predictable retail behavior creates these juicy pools of orders for institutions to come in and hunt. So if these common patterns aren't what's really driving the market, what is? Let's talk about the market's real fuel and the precise surgical mechanism institutions use to get it. Look, this quote right here is probably the single most important takeaway you're going to get today. If you don't know where the liquidity is, then you are the liquidity. This idea just reframes everything. Your job is no longer to find patterns. Your new job is to find where the stop losses are clustered. See, institutions operate in a three-phase cycle, often called AMD. First is accumulation. This is where they quietly build a massive position without moving the price too much. Then comes the fun part, manipulation. This is the stop hunt. They push the price in the opposite direction of where they really want it to go just to grab all that liquidity. And finally, there's distribution. This is the real move, where they start selling their positions to the enthusiastic retail crowd that's now chasing the breakout way too late. Now, within that manipulation phase, they create something very specific called an inducement. This is a small, tempting little price move that's designed to look like a really safe entry. It's bait. It's a trap, engineered to get you into the market right before they sweep the liquidity and slam the price in the other direction. Okay, so we've laid out the problem, we've talked about the mechanism. How do we fix this? Well, we have to stop trading like we're being hunted, and we need to start trading like the hunter. I mean, just look at the difference in mindset here. The mouse follows the pattern, buys the breakout, and places their stop in the most obvious spot. The cat, on the other hand, hunts the liquidity at that pattern, using those stops as fuel to get into their own trade. The whole shift is to stop reacting to what you see and start anticipating how what you see is going to be manipulated. So here are your new rules of engagement. First, you have to stop trusting obvious patterns blindly. Instead, your job is to identify where the stop losses are likely building up around those patterns. Then, you wait. You wait for the trap, that inducement, to be sprung on other traders. Your real entry signal is the liquidity grab itself. You get in after the stops have been hunted, following the footprints of smart money, not trading against them. And that really brings us to the hard truth of it all. The market is not some magical machine for making everyone wealthy. It's a highly competitive arena, and it is specifically designed to transfer wealth from the uninformed to the informed. Your one and only goal is to make sure you are on the right side of that transfer. So, after all this, it really comes down to a single choice. Now that you see how the game is really played, you can't unsee it. So, are you going to continue to be the liquidity, just acting as fuel for the big players? Or are you going to start hunting with them? The choice is yours.